I'll thank you everyone for joining out. I guess spend 45 minutes, and we'll either leave some questions towards the end, or if you want to ask questions as I'm going through the presentation, please raise your hand. I'm happy to address them. I'll just briefly mention, as Donnie talked about, and I'll just tell you a couple of quick stories there. When people talk, actually, my mom asked me, like, what is alternative investments? I do this for a living for 20 plus years. It's not easy to explain to someone who's not as familiar with it. So my simple thinking is, I think most of you would know, most of you would know stocks, bonds, FX, foreign exchange. If you want to be cute, you can do derivatives, which is essentially additional layer on top of stocks, bonds, and FX. I'll simplify there. There's commodities, other things. And when I think about alternatives, sometimes I even tell our client is anything that's outside of those public market area that I talk about, stocks, bonds, FX. Because there's no good area that people will cover that. So 50, 60 years ago, people just came up with the idea. I can't recall who came up with it, the term alternatives, because it basically says it's like a, I don't know, trash can. There's something that you don't want, they don't belong to stocks, bonds, and FX. You just stuck it to alternatives. So over the last 50 years, 60 years, the alternative space has become an area where, why I'm interested in this area is we look at everything. Everything has seen very conservative lending money to companies, very stable return. I'll talk about it. Real estate, you buy a natural gas pipeline, all the way to the most cutting edge artificial intelligence, AI. We'll talk about it today. I doubt, at least all my client meetings in the last year or so, you cannot get away without talking about NVIDIA or AI. A lot of the DNA-based drug biotech research discoveries, all of those things, anything in between, our alternatives team will look at it. And then when I came out of school, I'm just giving you a sense, I'm quite old, so I came out of school, it was 1999. If you have done some Wikipedia reading, you probably will recall that in the year of 2000, we had the technology bubble burst. And in 2008, there was financial crisis. Well, the last 3 years, we have COVID. So every time when there is a shock or distress in the market, I will usually say, when you come about, I run a business, the alternative investments business for the JP Morgan Private Bank, usually in the year 2000, 2008, 2012, 13, when there's a European issue with crisis, or the recent COVID, those were the period where alternative investments business were never better. I'll give you an example, like we more than doubled the annual capital raise in alternative investments. I'll talk about what they are in a bit, in the year of 2021, right in the middle of COVID. So the reason is that for stocks, bonds, and FX, well, in general, I will talk, if you have questions, I can talk about in details, but in general, when you do public investments, typically you expect that the companies will get better. They will be bigger, they'll grow faster. Fixed income, I'm sure you've taken fixed income classes. The reason that these things are called fixed income is because the income you can get is fixed. The coupons, the floating rate, I won't get into details there, but in general, you lend money to some companies, that's that. But in any way, those companies at the minimum should survive and keep paying you interest every year. So usually public markets, you think about companies need to do well, economy needs to keep chugging along and doing okay. It doesn't have to be high flying, but they have to be doing well. When things are dying, and then when there's a shock, like 2000, 2008, COVID, this is where a lot of the alternative investment managers do that. It's not because these people love dying companies or things. Most of the, I would say, industry practitioners, these can be portfolio managers, founders, they used to be, many of them work for large investment banks or large mutual fund firms back in the 1950s, 60s, 70s, all the way until recently. Usually at these firms, even banks like JP Morgan, we used to have what we call special situations group. What are they? They're usually a small team sitting in a corner, nobody cares about them, until when some of these large investment banking deals or some of these companies that the banks are helping them, whether they're lending money, helping them to raise money, high yield bonds, you might have heard about them. All of these things, when these things go wrong, then those deals will get shipped over to the special situations group in the corner where nobody cares in the good old days or good performing days. And those people tend to have backgrounds as they're lawyers. They're very good at details in documentation. They're accounting, sometimes a forensic accountant. They might be journalists, they might be traders. All they do is there's a dying company. Sometimes the bank itself might have money in that company as well, as either lender or as a direct investment. So how do you not letting the thing go down to zero? Are there things to be recover? Are there things to be even just selling the thing into pieces? You can get some money back. So that's how the whole industry started. And the reason I show this chart here is nowadays, this is 50, 60 years later, alternative investments is an area where I always tell our clients, when they come to JP Morgan Private Bank for looking for alternative investments, whether you feel good about the economy, you feel good about the future, artificial intelligence, things will go through go to the moon, or you feel really bearish about whatever, US upcoming presidential election, issues in China. People are not spending money like the last long weekend here, 4 days. Most people left Hong Kong and went to Shenzhen or other places for spending. So what about the consumer, the restaurants here in Hong Kong? In alternative investments, we can always find the right team or manager who can make money whether the market is good or bad. What the managers, they focus on buying some of the private equity I'll talk about, some of the real assets. When there's a building, nobody wants to move in. There are ways to make money out of it. So I always find it that in whatever market, alternative investments, we can make money out of it. That's something very important. The second thing I'll quickly mention, it may not be too much of an interest right now, but I'll give you an example what this chart looks like. It's more or less for the last 20 years, the annual return you can generate, and you can see the vertical columns there. There are different, we call them asset classes, but you can think about them as, on the left-hand side, some of the mutual funds you can get. So there's some US public equities, there's bonds, real estate. On the right-hand side is what we call alternative investments. So there's private equity, hedge funds. Venture capital is you invest in some of the very early stage entrepreneurs there. What the chart shows is that on the left-hand side, which mutual fund you invest with, let's say they're all US equity or US S&P 500 large cap focused mutual funds. The return difference between a good performing mutual fund and an average or a not so good manager, yearly return is not that big. It's about 2%, 9.6 versus 7.8. But on the right hand side, you can see that if you pick the right or wrong global private equity manager, your yearly return can be huge difference, over 20% a year. And you can do your geometric mean math. If you can generate 20% extra return a year, and most private equity investments are 5 years, 7 years, 10 years, you can do the math in dollar terms or value terms, how much additional investment a good manager can generate. And why do I highlight this point is, before I joined JP Morgan in 2011, I used to do hedge fund due diligence. What we do is we try to find those good performing ones. The 26.5% on the page is not even the top performing. This is just the top 25%. We call them quartiles. This is not even the best one. We actually don't care about the best one because most managers cannot stay at the best one forever. They come and go. The statistics I will give you is that for any 5-year period, if somebody is the top performing returning private equity manager, the chance that in the next 5 years they will stay in the top it's less than 10%. A lot of them, they come and go. So our job is try to pick the right one there. So manager selection is what we call in this category. It's super important there. I'll skip the our firm thing, but I do want to highlight at JP Morgan. One of the things, well, this applies to many of the banks too, is think about it as, I always think about it as if you go see a doctor, somebody's not feeling well, there's always the general doctor, the GP, family doctors. So usually you go see them first, not because you want an insurance claim and you want to get a referral letter, it's because they are usually your first one to see what's wrong with you in general. So they will do some testing for you. And then they may refer you to specialists. So for our alternatives team, it's not actually one team. This number is a little dated. By now we have about 150 people. I belong to the portfolio specialists here, but we are a team of quite a number of different specialists. So in the structuring and accounting and tax, we have a lot of lawyers background. Why? They are our legal document experts. I guarantee you many bad investments and deals. It's not because the investment or the due diligence or the people picked the wrong manager or anything. It's because we did not see one small sentence in a 300-page document. We miss it. And that sentence may come into play in some specific situation. We actually have managers, if you're interested, towards the end I can tell you a story about it. They are actually special situation hedge funds. The whole team is lawyers. All they do is to get like the high yield bond, I don't know, I can ask people here, like if you have seen a loan document, high yield bond offering document, they're usually several hundred pages. Nobody reads this. Most people will care who is the company, what is their credit rating, coupons, duration, all that. And if it's a good company, that's about it, and people will start investing because these are fixed income. There are people who read those several hundred-page documents. And sometimes they can pick up things that can make very decent return out of it. So the whole essence is, if you're thinking about your career, sometimes you think about big picture, I want to join an investment bank, I want to join maybe asset management, private bank. Do a little bit more homework and start thinking, it's actually not just private bank. There are actually many different roles within bank. See, I would say, well, one is what you are interested in. Second, more importantly, what you are good at. Not everyone is good at structuring or accounting. You might get bored after reading financial statements for 30 minutes. That may not be your job, because if that's all you do for years, but some people love that. Don't bother me, I don't like to talk to people, I just like to sit there and read statements. That's fine. So think about what you are good at, and that's usually how you end up with some of these specialists there. The other thing I mentioned about, you need to partner with the right managers, because in this space, it's all about you're finding specialist doctors. Think about it that way. If it's just a general common flu, COVID or anything like that, you can go see any doctor, they give you some Tamiflu. If you're serious, that's about it, you'll recover. But if somebody has really serious illness, like cancer, there's a tumor in the brain, you need to do major surgery, you want to get a specialist doctor, and not just any doctor, but you probably, it's your life on the line, right? So you want to get a very good specialist doctor. And that's what we do at JP Morgan, which is helping our clients to pick the right manager. Why? There are over 5,000 so-called private equity managers out there. There are over 10,000 hedge funds out there. We can tell you we've met many thousands of them. It's less than 5% of those managers is actually really worth your money, our clients' money to invest with them. The 10% all the way to, call it 85, 90% spectrum is what I call the average Joe manager. They don't destroy too much value, they won't make you a lot of money. What you ended up doing is after 5-year, 10-year, you keep those portfolio managers alive. They make a good living charging you fees. So you end up paying a lot of fees, getting mediocre return. So we try to help you avoid that. The bottom 15-20% of it, those are flat out bad managers. If you're interested, I can tell you some examples of what they are. Some of them just flat out accounting fraud. You might have heard about Madoff, any of those. Knock on wood, we never had any of those experience, but those are literally con artists. They're not there trying to help people make money or invest. They're trying to get money from your pocket to their pocket. They're criminals. So there are bad ones out there. Why? Because alternative investments is not like mutual funds. They're not as highly regulated by the governments. Now that there are more regulations, but anyone, you can go tomorrow, register a Shell empty company, and call yourself a hedge fund or private equity. Put your name on the door. That works. Albert Yen Capital. A lot of these are a founder's name. So I'm not saying you're a con artist, but I'm just saying it's very easy the barrier of entry to these industries is not that high, but it's very difficult to be the good ones there. The other thing I want to mention is, again, as I said, there are some statistics at the bottom of here. We spend a lot of time meeting as many managers as possible. By the way, there are 150 people on our team. Many of them are like me. I'm always curious at everything and anything almost. Anything that moves, anything doesn't move, anything used to move and now stop moving, or the other way around, I get excited. If it keeps moving the same pace, I don't care. But if it stops moving, sometimes you wonder why. And then the reason I said that is it's highly selective in the alternative investment space. You show that the chart I showed you before, it doesn't matter as much when you pick the wrong mutual fund. You maybe just sacrifice the return a little bit because they are highly restricted in what they can invest in by the government and the other things. But private equity, hedge funds, technically speaking, these managers can do whatever they want. There's no limit to how much borrowing or leverage they can do, what type of company they invest in, regional focus. They can, if they want, they can put 100% of their money raised in one company. It's do or die. It's allowed. So that's why you see some companies, private equity funds are having very high returns. It's our job to figure out how did they do it. If they put all your money in one company, it will be very low chance that we'll work with someone like that, because that's purely concentration risk, and then you can do the other secondary layer to see how did they get the company. Is it by luck, or they actually have some way to find it? I'll talk about it a little bit, but keep in mind that in this industry, it's all about seeing as many as you want and try to find the few that work well. So that's some of the things that are quite important in due diligence world. I'll give you a couple of examples what kind of things private managers can do. There are a couple of examples here. The name doesn't matter as much. You may not know the company, but I'll give you a couple of examples. On the right-hand side, there's this company called Co2. They're based in New York. They are a technology investment specialist. So they invest in tech companies, both in stocks and also in private companies. So I'll ask you a quick question. This is a fund called Opportunity Fund. So we know the manager very well. His name is Philippe Lafond. If you have time, you can go Wikipedia and look him up. It's a pretty interesting read. So he's been doing technology investing for many years. He started his firm, Co2, in 1999. Before that, he spent several years at another fund, hedge fund, pretty famous one, called Tiger Management. Julian Robertson is the founder of it. They're known for doing very detailed company analysis and pick the right stocks, and then they invest in. So Philippe Lafond, we know them since 2006. Our private bank have been investing with him for many years. Great. So he came to us in actually early 2020. It was actually late 2019. He came to us and said that he wanted to do a raise in today's world. It's small money, US dollar about $1 billion. He wants to raise a fund called Opportunity Fund. So we're like, okay, what do you want to do? So he wants to actually, because in early 2020, as most of you know, COVID started breaking out. So he wanted to actually buy about investing 20 to 22 stocks. And these are actually companies that, so we were asking, so what kind of stuff you want to buy? Microsoft, Disney, Amazon, Netflix, there's some not successful one like Uber, Zoom, which all of a sudden, I don't know about you, but before March 2020, I've never heard of the company called Zoom. It started in 2012, right? But because of this incident, Zoom, the stock price went to the roof for a short period of time. It came back down. But anyway, the reason is they came, and then we were like, okay, so you're buying 20 stocks. We all know the company names. And then you can ask all the clients. I can ask you, I don't know if you were paying attention or you were doing things. Would you buy anything in March to August 2020? Microsoft, Amazon, Netflix. Most of you probably would hesitate because at the time, during the crisis, in the middle of the crisis, who knows how long COVID will last? And I highly recommend everyone, you watch news, you look at your social media, you look at how your friends chit chat, have your own opinion, but don't get biased by whatever your, especially the press. I'm not against journalism or anything like that. If you have majors here, no discredit to it, but think about them. Like journalism, they want to make money by attracting more eyeballs. So usually when there's a crisis, they want to make it look more serious, sound more serious than it really is. And they'll create some fear, so you watch more, so you know they get more advertisement out of things. So that's the thing that we started, and saying, well, we need to actually pay two pretty expensive fees to do this. So he started buying these 22 stocks in March through August 2020. That was like flat bottom, dirt cheap at the time. Nobody was buying them. Within 1 year, so he sold everything in less than 11 months in middle of 2021. For after his hefty fee, he took a 20% haircut on the profits. He returned 97%. So essentially, you put $100 in, he gave you back $197 in less than a year. Right in the middle of COVID, where people were not willing to buy stocks. So I'm saying like these hedge funds are not magic. They're not coming up with a company that you've never heard about. But whether you're willing to buy it or sell it is very important. Because in 2021, even if you manage to buy some Microsoft and Zoom, by 2021 you will say, well, things are doing well, Zoom is going through the moon, why should I sell it? That's why they decided to sell it, because I don't know if you can go back and look at the stock chart for Zoom. Not quite in 2021, but not too long after that, the stock price started coming down when people start traveling and start, doing less Zoom calls there. So these are the type of managers that we work with. This is another way of showing a chart that I love it a lot, which is there are many different strategies. Usually, whatever objective our clients, or when Donnie talks to you about investments, whatever objective you want to achieve in your portfolio or in your assets, on the horizontal line there are usually quite a number of common things people want to achieve. You want to reduce volatility, you want to increase return, you just want to have diversification, not all your eggs in one area, equities or bonds or one region. Different alternative investment strategies can help you. So the purpose of having some alternative is on this page, depending on what you want to achieve in your portfolio. Usually a lot of our clients have a mix of a number of these things there. So that works pretty well at complementing many clients' investment portfolio there. I'll give you a couple of examples here about what exactly I'm talking about. You probably won't recognize some of these logos here. It's not important, but I'll talk about two things. Buyout and growth equity. Buyout, you might have heard about it. Most people originally called private equity as buyouts. What that really means is you buy a whole company. You own either 100% or you own majority, over 50% ownership of the company. Why do you want to do that as a private equity firm? It's because then you can control the board, the CEO, to change the direction of the company. Either it's a company's doing not so well, or a company's doing well, but you can grow faster or grow bigger. So that's what buyout managers do. I'll give you an example, and keep that in mind. Is we love buyout because this is in the private equity spectrum. There are venture capital all the way to buyout. This is the most stable, steady returning one. I would say, on the rule of thumb, if you can find a private equity buyout manager that can give you about 2 times net return on investment, we call multiple on investment, MOI, over, call it 8 to 10 years, it's a good manager. Anything more than that, you probably have to go a bit more aggressive in the earlier stage of the company. I'll talk about it in a bit, but I'll give you an example. We work with a manager called Carlyle Group. You might have heard about them. Carlyle is a pretty dominant. They manage about close to $400 billion of assets globally nowadays. They have a very successful Asia buyout fund. I just want to check, like, who loves McDonald's? Like, I'm a big fan of McDonald's. I think it's somebody, I hope some of you are big fans of Mickey D's. I don't know if you are aware or not that McDonald's Group have a few issues and problems they used to face back in 2015 and 16. One of them is China. These are facts. So back in 2015 and 16, McDonald's Group have more restaurants than KFC, Kentucky Fried Chicken, in almost all countries except one, China. In 2017, when Carlyle actually made the investment, there were over 5,000 KFCs in China. There were less than 2,500 of McDonald's in China. Well, you can talk about why. People, the Chinese love more chicken than beef, whatever you want to talk about it. It was never a focus for McDonald's. The other thing you probably don't know is from 2017 until late last year, 2023, this 6-year period, the Hong Kong, Macau, and China McDonald's, all the restaurants, start with about 2,500 of them, are not owned by the McDonald Group. They sold the entire Hong Kong, Macau, China business to a company in Hong Kong. It's called Great Food Holdings. The CEO is a very famous person, Phyllis. She does a good job at managing it. So they took it over, and then the large investor owner, it's not the CEO, but Carlyle Group, they bought McDonald's. And you were saying, why would you want to buy McDonald's, which is, I don't know, for most people it's a so old school company. That's because they're not doing that well in China. So what did Phyllis and the team do, and Carlyle do? In a matter of a couple years, from 2017 to 19, they did a few things. One, there is the new mobile app, Mamasong, which is their mobile. So you can order that there. Second, they started working with companies like Deliveroo and other things. Third, they're starting to open more restaurants in China. Well, you can say, well, I can do it, you can do it too, it's easy. No, they're not opening the same type of McDonald's. If you go to I don't know if you go to the IFC, or there's one McCafe, and others, if you haven't realized, you can go take a look. They're quietly doing that in Hong Kong too, but if you go to China, it's more prominent. They're opening new stores, but the new restaurants are much smaller in space. Because I don't know about you, most people nowadays will order McDonald's either through the app or Deliveroo, and you go take away and you bring it home. You don't sit down at the restaurant eat as much. Maybe you do. I used to. That was my days when I went to high school here in Hong Kong. That's after school. I go hang out with my classmates after football, soccer games. But that's me. Like, I don't think any of you would hang out at McDonald's after school these days. So they don't do that. They put on the digital menu. Now you can order. It's easier. And then there's other few things that they do. I don't know if you are aware. Of all the food items, what is the highest profit margin item on the McDonald's menu? you probably will be surprised. It's not any of the burgers. I'll give you the hint. One is filet o fish is the least profit margin, like the least profitable business. So they don't actually like selling filet o fish burger. The most profitable one is actually the breakfast. It's the sausage, egg, macaroni. And that's a Hong Kong only thing. Why? Because Phyllis came up with the idea. Macaroni is a Hong Kong local restaurant breakfast thing. And for McDonald's, they don't need to do too much new innovation, new tasting. They still have that same sausage patty, the eggs, there's no difference. Instead of putting in the McMuffin burger, you just put it on macaroni. So all you need to do is buy some macaroni and cook, which is very cheap. But that became a very popular item and very profitable. So they did all these things. And then, well, nobody ever expected COVID happened. So it did. And that also by luck. You know, people start ordering more, you cannot go out, so that's not, I would say, Carlyle or McDonald's skill set, but they experienced that. Long story short, from 2017 to 2023, the McDonald Group, Hong Kong, Macau, China business, they've been opening restaurants, 1,000 restaurants per year for the last 6 years. They've been doing very well, they will continue to do that. Second, this whole company, the holding, they bought it for $2 billion US dollars back in 2017. When they sold it in 2023, they sold it for $12 billion cash. So they made over 6 times money. I always joke about it. If you can make 6 times money by flipping burgers right in the middle of COVID, we're not talking about AI, we're not talking about innovation like new drugs, cancer curing drugs. No, we're talking about good old flipping burgers during COVID. That's why I would say, why not invest with a manager called, a manager, private equity manager. And they love doing things in the traditional industries. Like food and beverage is a very traditional industry. I guarantee you none of you here, maybe you do, I don't know, but would say, oh, I'm looking for a job for next year. I love to join the McDonald's group. I doubt that's your number 10 choice. I doubt it. But they can do that. And that's great. And the last thing I will highlight on that is, so who is actually or did pay $12 billion US dollars to buy McDonald's in 2023? We closed the deal in December, right before Christmas. Actually, the news was, if you actually did some search, news leaked out in October last year that Carlyle wanted to put McDonald's Hong Kong, Macau, and China as a public company listed on the Hong Kong Stock Exchange. And then our dear journalism came in. They came in, one, the Hong Kong stock market is not very hot. Like if you put it on IPO, nobody will buy the stock price will come down. Second, they did their homework, they're good. They realized that when McDonald's Global sold the franchise to Carlyle in 2017, they kept 20% stake. So they did not sell the whole thing, they sold 80% interest to Carlyle. They kept 20%, but they also kept a clause, is if McDonald's want to list as a separate company in Hong Kong, McDonald Global needs to have a blessing, they need to agree with it. So the journalists say, McDonald US will never let McDonald China to go public and that of things. So that news somehow got leaked out to the press. And then we were talking to our manager, Carlyle. The manager sort of disappeared for a couple of months. Not disappeared, but he was saying he could not comment on that. And 2 months later, he called us back and say, actually, we don't have to go listing. By the way, they were trying to list for about a little over $10 billion. So it wasn't quite $12 billion. So he came back right before Christmas. He was like, yeah, I went to the US. We don't have to sell IPO. IPO is actually not the best option for a lot of these because when you go IPO, listed, you cannot sell your stock if you're a major shareholder right away. There's a 6-month lockup, and then you need to gradually sell it, so your money will come back gradually. So they actually sold the whole thing, all cash, to the McDonald Global. So sold it back to the owner. And then so you would, someone like me will always say, well, why was somebody so stupid paying 6 times more money to buy back the company where you sold it in 6 years ago? That's the essence. Actually, that happened a lot. I don't know, if you go to a Korean barbecue, one of the beer that you would drink is called OB, Oriental Brewery. That's another very typical example we did with another manager, KKR. This was earlier in 2013 and 14. They bought the OB beer company, that's Korean #2 one, in 2012. From a company used to make beer in the US, Anheuser-Busch, they make Budweiser. They bought it, and 5 years later, they sold it for 5 times money back to Anheuser-Busch. And OB in that 5 year became #1 beer seller or distributor in Korea plus other Asian countries. And so that's a very typical buyout story. They are not magic, they're not the ones coming out with what's the next cutting edge technology or everything, but they are operational specialists. They can come in, figure out how to increase profit margins, cut costs, where to expand in traditional companies. Beer company, burger company, I picked 2 examples. There are other things that you don't think of as interesting stuff. They are very good at it. These are industry specialists typically. So that's what buyout is about. I'm very interested in because these things are usually not counter-cyclical, but they are usually at the time when they buy these things, probably there's very few competition because nobody cares about McDonald's in China. That's one. I'll quickly talk about one growth equity. These are really buying the dreams of new innovation, venture capital a little even earlier. We have a manager called DFJ, Draper Fisher Jurgensen. If you have time, you can go look it up. DFJ are the first letter of the 3 founders' last name. So they do technology investment, and one of the companies a few companies they invested in are now pretty well known, but they are all Elon Musk companies. So one of them is Tesla. So you will say, well, Tesla, not everybody knows it. It's so obvious. What's so cool about it? I'll give you one example is most of these private managers, because they sit on the board, they actually own a lot of these companies. So they actually know and sometimes drive the future growth of these companies. So I'll give you an example. If you buy Tesla today, it's not very interesting. But in 2009, that's where DFJ invested in Tesla. I won't talk about the stock price. If you want to adjust that, it's less than $12 at the time. It went over 600 at some point. But the interesting thing is, what's so cool about 2009? 2 things happened. One is, a year earlier, Elon Musk, and I don't know if you are aware, Elon Musk is not the founder of Tesla. He just squeezed himself in and then forced them to add a clause that he is a co-founder. But in 2009, Tesla already exists for a few years. They already have their battery technology, the powertrain, the software management system. But back then, the Tesla management team's idea was, we have all these electrification systems and batteries. We're not making cars. We're selling these technology to the Toyota, the GMs, the BMWs, to supply other car industries so that they can have EV vehicles down the road. And then Elon Musk came. They're like, if you have so cool these technology that are so good, why sell it to other car companies? He wanted to make his own cars. And then everyone in the boardroom was like, you're crazy, the car industry is an over 100-year-old industry. Now every single car, back in the days, like a single car you can sell, if you can make 8% net profit margin per car, it's already a very profitable company. It's no margin business. because the profit is so low, you have to, well, not that in Hong Kong, but in other US, like pay to the dealers. There are a lot of things that you have to give away the profits there. So all the board was like, like, look, like nobody will make cars as a new company now. So he came up with the objective. Most people think he's crazy. I want to make cars myself, EV cars, and I want to make a car that has a 25% profit margin. So every car you sell, he needs to make 25% profit on it. So everyone was like, okay. So then he went away for about 3 years before the Model S, the first one, came out in 2012. And that's the year when DFJ invested because they believe in a crazy guy. DFJ was telling us that every single company they invest in, they don't do much. They invest in 3 to 4 companies a year. At the time when they talk to us every single deal, every time we listen to the portfolio manager's name is Randy Klein, he was here a couple weeks ago. Like at the time he pitches you a story, we will all think that he's crazy. And he's investing in company founders who are crazy too. But then you need these type of people, when I'm not saying they're crazy, to drive, I don't know, a lot of these Steve Jobs, they just are not happy with what they have today. So you have people who change the world. Long story short, Tesla was very successful. They invested in another company, SpaceX, along the same line. So you would say, what's so cool about other than Elon Musk started involving with Tesla? Second is 2009 was right out of the financial crisis, just recovery. Tesla was on the brink of about to go bankrupt. They're running out of cash. And then that's when a year you can get in at a very cheap price. Today, like Tesla was a listed company, even though if they're a private company, they probably wouldn't need our money because they have money. So that's a pretty important thing I want to highlight. Like sometimes you depend on different managers to identify, but they all have one common thing is they know something that we don't know. And then they have a mission there. And I'll quickly finish up on some of the things on the credit side, which I think you should be aware because it has become more and more popular over the last 2-3 years about lending money to US companies, but not buying high yield bonds or investment grade bonds. Those are public paper issued by companies, usually with the help of the investment bank. They do a syndication, meaning they do a roadshow, marketing process and sell it to many different institutional investors. There's another area we call it private credit is companies do not go to public markets or to investment bank because they're too small. Too small, I don't mean they're like a 5-person company. They usually make less than $100 million of net income or EBITDA, if you care, accounting terms, per year. These companies are usually too small. The investment banks will never entertain them to help them raise a high yield bond, or they usually don't qualify for investment grade quality. So they will go to a private equity fund. Above there are some company logos. These are pretty famous fixed income managers. What they are good at is assessing, one, which companies will not get into trouble. So keep in mind that when you think about fixed income or credit investment, whether the company makes a lot of money, does it grow or not, they are not the most important thing. The most important thing is they generate cash flow every year, every day. And where do they come from, and are they stable? As long as they can pay your interest, and maybe when it's maturity, typically these are 5 to 7 year loans, they can pay back the principal. That's all fixed income credit managers care. You don't have to be the high flying companies, as long as you don't get into trouble. So these are what private credit managers do. Why this is important? There are a couple of reasons. One of them, Donnie and I were just talking about it earlier. It used to be a lot of Chinese investors, for that matter, international investors too. Everybody loved the Chinese real estate market property bonds because they always think that's not bulletproof, but it's a very safe area. Even if things go wrong, the Chinese government will bail you out. It will never go wrong. Well, it did in the last year and a half. So a lot of the money that used to be in the Chinese real estate bond segment um, came out. If you still have money left there, because a lot of bonds were down 90%, and then they moved to the U.S. And this area, I just highlight one point is, well, lending money, you say, well, I look at the company, it's a software company like Netflix, they charge you monthly fees, so the cash flow is pretty stable from a revenue perspective. That's not too important. When you deal with fixed income credit managers, usually their first thing is not what is the interest payment with the percentage coupon on the loan. No. The number one thing is, if I lend you money and tomorrow your company goes bankrupt, what is my recovery value? What do I have in return? I can take from you, you can sell some of your assets, sell some of your future cash flow receivables or some of your people, like there are things that I need. So that's usually the number one thing. Then we talk about price. Coupon distribution, that's price of how much you're willing, the riskier the company, you charge a higher coupon interest rate. So this area has grown very significantly over the last 8 years. So nowadays the private credit market is over $2 trillion US. It's actually bigger than the high yield market. High yield market's been around for 30, 40 years. But this is a very booming market. So if some of you in the audience, you love fixed income credit analysis, this is one area that you might be of interest, because there are quite a few specialists doing that there. I'll quickly finish up. I think time is up on real estate. I'll just give you an example of what we're talking about. So real estate, there are many different ways to make money in real estate, but I would say two typical way is think about a lot of, like I would say, if you have been paying attention, whether it's in Hong Kong or in the US, office buildings is probably one of the most hard hit area in terms of real estate. A lot of companies move out of New York City, Manhattan. They either people will work from home or they move to other states like Florida. Well, people from San Francisco will move to places like Texas. There's a good reason for that, is because it used to be Florida, Tennessee, Texas. They do not attract technology or biotech people. People don't go there. Texas is like oil stuff, so they run out of oil to do. There's no business there. So then Texas came up with the idea of, well, how do I attract people from Silicon Valley and San Francisco to go? Is I reduce the tax, income tax, state tax, city tax. So a lot of people from San Francisco, being one of the highest paying tax cities, New York City is another one, moving to Texas. And now you can work from home. A lot of people can work from home or work from remote offices after COVID, so it works very well. Real estate is an area where people always say location, 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 but that's not the most important thing as well, because if you know what to do with office buildings in New York City, you can make a lot of money out of it. Don't always think that a office building, if you buy, you can buy dirt cheap right now because nobody wants it. If you think, well, I buy a building, I do some renovation, and then put it back on the market as another office building, well, unless you can come up with a way somebody will rent it, there's no money to be made. So some good managers like Starwood and Blackstone are top quality real estate manager investors out there. They will repurpose the building. For example, you can change the office building, keep the layout, the frame, renovate inside, make it more like apartment complex. Or you can make it into a warehouse data center thing, not in the middle of New York City, but in rural areas. There are people doing that, converting factories and some office buildings, office park type of thing into these. Why? Because now everybody wants data centers. Data center is the hottest real estate segment there. So if you know how to do it, you can make money out of it. So that's why real estate is another area, just like the buyout one I talked to you about. You need specialists to do that. So these are some, I would say, examples I share with you. hopefully to give you some sense of what exactly these strategies do. I rarely want to go into what is private equity, but through examples, hopefully you get a sense of what they do. So I'll stop here. There are some other areas, if you want to talk about hedge funds, I'm happy to go through it, but I'll stop here and see if you have questions.
Yes, just feel free to ask a question about the investment or anything interesting.
We look at everything. So then there's a few healthcare biotech like Red Mile specialists out there, RTW, or other areas that you're interested in.
I have a question that you mentioned about repurposing the real estate, but apart from the location, is there any like legal concern maybe when building is built that
Yep.
then it would have to be like for office use, it cannot be used as residential
Good point.
buildings,
Actually in Hong Kong, this is a very important thing. In New York City, actually most of the cities changing what we call the building code or the purpose of the use of that property is one of the biggest challenges. So a good manager, one, they know what to do. Seems like that's one of the call it nitty-gritties or one of the things. Because if I buy a building, as one is you cannot even convince the government to allow you to make it like into an apartment. And second, I'll give you one quick example is if you've seen pictures of if you've been to New York City, a lot of the buildings, office buildings, are pretty old. Many of them are built back in the 1960s, 70s. Some of them are like we call them pre-war, so they built before 1945. They're old. And usually it's one, as you know, New York City is square street blocks. So one block you have sometimes one building, office building. If you buy it, even if you can convince the government to allow you to change it to an apartment, that still doesn't work. Why? Because office building usually is just one big block, you have windows on the side, on the four sides. But building code for apartments, at least in New York City, is every single room, including the kitchen, the bathroom, the maid's room, everything needs to have a window. That's just a building code for apartments. That's a requirement in New York City. So if you have an old office building, you can build apartments on the for area. What do you do with the thing in the middle? You can say, well, I'll put elevator base there. That's fine. But some of the old buildings, one of the things they need to do is literally, you think about it, drill a hole in the middle of the building, so that the interior you have windows facing what. It says you have to have a window. It doesn't say you have to have a window with a view. So they need to put a window. So that's another small things like someone who knows what to do versus who doesn't know. Like it's, I only need to convince the government. Sure, you can convince the government. And then the other thing very important is even if you know drill a hole in the middle, I would say then how much is it safe? Because you're drilling a hole in an existing construction. What else you need to do, and if you have to spend a lot of money on that, you end up building the whole thing, but profit margin is very important. You cannot sell it for a profit. Why do the project? Because there's always risk on who will rent it at what price, which you cannot quite control. So there are a lot of nitty-gritties. Good point. Even in Hong Kong, there are many old factories. Some of them converted into offices like in Boon Tong and some of the Kowloon Bay area. Some are not. It's not because government is not willing, it's because the owner either they're too lazy or they have no clue how to convert that. Just go make an application with the housing department in Hong Kong and see if you have an apartment, let's say duplex, you want to add a stair in your apartment. I think there was one in Korea Bay or somewhere got into trouble with it. But that's a 2-3 year project alone. Not to mention, like you probably just for the application, I understand it's over $2 million just to send the application. So cost is something that's very important.
Thank you, Albert. So just want to ask, like, as we can see,
question specifically, I'll mention a few things. One is when you talk about real estate, or when people talk about real estate with you, at some point, either you're doing it now or sometime in the future, you probably will consider buying a house, or might buy for investment purpose or your own self-use purpose. I would say be very local is one thing. So there is no Hong Kong real estate market. There's no China, there's no US. To us is New York City or San Francisco, and it's also by the US is the postal zip codes. Very specific. In Hong Kong is different area. Like Central, here, Causeway Bay, very different. So the people, because journalism or newspaper, social media, they love to talk about Hong Kong stock market is, or Hong Kong real estate market is challenging, or China is challenging. There's there's no China. It's very specific. Second is, to your point, overall right now, almost, I would say, overseas institutional investors, nobody's playing China at the moment. It's not about government, it's not supporting or anything, but there are better opportunities out there. So you would say, like, where are they? The largest one is still in the US. Not in the, what we call the first tier cities. There's about 13, 14 of them. So your Chicago, San Francisco, LA, New York, Boston, those are not the hot area. Usually what we call the Sun Belt cities. So there are the states in the south of the US. They usually have nice weather. The demographics, so population, people are moving there for lower tax reason and better weather. It's not just for retired people, even for workers nowadays, a lot of them move there. So that's one area where we're seeing pretty good growth. Texas, Florida, Georgia, Tennessee, Carolinas, those are areas where we're seeing increase in office buildings, warehouse, logistics, data centers. They're doing pretty well. And then Japan. Japan is an area, whether it's real estate or it's actually private equity. That's another area we actually see a lot of people will say, well, if I don't invest in Chinese real estate, not everyone will move money to the US. Either one, they cannot, or second, they feel like that's so far away, I cannot touch and feel it, I cannot see my homes. But Japan is a lot closer. So Japanese real estate market is something that we're seeing, but there, to the point, question with another student here, there are very unique situations and cases about Japan real estate market. So everyone has very detailed issues and area of growth there, but Japan and US are usually the largest. Europe is sort of a quiet area. There's not a whole lot of growth there. People still do that, but usually just buy some nice property in, for example, the 6 major cities in Germany for rent purpose, but you don't expect the home prices to go up a lot.
So as you mentioned, anything you see your older managers are working on in Japan?
Yeah, so Japan, 2 types for real estate. Typically, most people say only focus on Tokyo and Osaka. So only 2 cities. Apartments, so residential apartments, office buildings. That's about it. There are not as many warehouse logistics and data centers yet, but we expect data centers will be something that's coming up. AI development is another area where you need multiple folds of data storage increase over the next 5-10 years. So data center is a hot area, but apartment and office buildings. The second tier cities, smaller cities, usually pretty low. It's like if you go to France, you want to invest in real estate, it's typically Paris. There's not that many areas that for international. If you're not a local, it's very difficult to make money out of it. But there, one unique thing about Japan is if you can borrow mortgage or borrowing on your real estate in local currency, in Japanese yen, it's one of the most important area you need to figure out. If you cannot borrow yen locally there as a foreigner, you may want to think twice investing there, because some of these firms I mentioned above, like Blackstone, they have ways to borrow yen, and they also have other terms that you can get away. For example, I think in SARS time in Hong Kong, those people first time start realizing the issue of what we call negative equity. So if you have an apartment for $10 million, you have a mortgage for $5 million. If the home price drops below $5 million, some of these mortgage terms will require, the banks will require the owner to top up, adding back equity to make sure that the bank has sort of $5 million worth of collateral there. That's also true in Japan, and it's even worse because in Japan you can borrow 90%. So your price dropped by 10%, you need to top up. But Blackstone can get away without topping up. So they negotiate for terms that they don't top up. That's quite important because that helps when you have more challenging time, and when things go wrong, do you need to chip in extra cash or not?
I watched a video of Elon Musk saying that the demand for electricity will be skyrocketing in the near future.
Yeah.
What do you think about it as an investment opportunity?
Yeah. We I didn't go into the details, but real assets, the reason we call them real assets is because other than real estate, one of the other area we really like is infrastructure. Infrastructure accounts for, there are quite a number of different types of them, but think about it as the power grid, the power plant. It doesn't have to be coal-based, it can be natural gas-based, and a lot of the other renewable energies, although that's not the hottest area recently, and a lot of the other things like data centers, they're all in infrastructure. Infrastructure is an area we like a lot. Donnie was asking me to share a couple of trends for the last year or so within the alternative investment space. I will give you the sense of a few areas where we're starting to see a lot of client investment putting into it. One of them is infrastructure. The other one is things like Japan, private equity and real estate. Of course, US private lending is an area that we see a lot of. So infrastructure is a key area that we're seeing. It's like whether economy is good or bad, doesn't matter. You need to keep the lights on every day you wake up. You have hot shower, there's water supply, sewage, all those are infrastructure.
Another question is, I can tell that your job or skill set is to differentiate good investment and managers, and I believe that will need a very good mental model. And how can you persuade or convey your skill set or your ability to your clients?
Well, I'll put it this way. Think about it as I think instead of introducing you to a fund, it's like I try to convince you to go try a restaurant that I love. I usually tell a lot of the new joiners, analysts to our firm, it's like I don't do consulting firm back in the days, but Boston Consulting Group, McKinsey, they all do the same thing. If you have a problem like you mentioned about how do I convince someone to buy something, break that down into smaller problems to solve. One is, what is the actual thing you try to sell? What are the good, we call them the highlights, or what are the strong points and not so strong points? Second is, work on your pitching, convincing, storytelling skills. Those two are separate things. Most people say a lot of people focus a lot about what you're trying to sell. Returns and everything. I will tell you this, like if there's a buyout fund, every single year for the last 30 years, they give you 25% net return. They never had a failed bad investment. Every single investment they made money. Over 8 years, they give you 3 times net return. Way better than S&P 500. If you can find such thing, we don't need me. Like it can sell itself. But I can tell you that description of a fund never exists. There's usually a fund that gives you 1.8 times return, 14% return a year. a little better than the S&P 500. They may have a few bad deals, but by and large, above average, they do well. So how do you convince people to buy that? It's where the pitching. So, but pitching something like that is difficult. So I usually suggest people say, you just had a 4-day weekend, long weekend. You come back and say, I went to the art basket. I saw a really cool BYD seal car on the street. I had a really nice bottle of wine. I went to a brand new Italian restaurant in Thailand. Sell me that. I tell our analysts, just tell me whatever you like. You bought a new handbag, you bought a new watch, you got a new the Rabbit R1 gadget. I ordered one in 2 months, it hasn't come yet. I'm playing a chat on the ChatGPT type of thing there. Something you love, and focus on the pitching. Because the thing, I guarantee you, it's very rare you can find a 100 points thing. But you get a lot of 75 points stuff. The 50 and below, hopefully our job due diligence, we tell our clients, will avoid that. So the due diligence people, what I used to do is, we try to not screen out, but spending a lot of money meeting managers, the below average and the below 30%. But the top 25-30% is what we try to do. And if you say, how do I convince? Well, most people look at returns. So if you can deliver consistent return as a recommendation, meaning, I don't know like which source, I don't, but which source of restaurant review media you look at. I don't know, do you look at Open Rice? I don't like it, but I look at it, but I don't take it very seriously. You have your famous review, like why Michelin star works. I don't know if you buy it or not, but I don't care. Like what we do is we try a lot. I don't care about Michelin star. I don't care about Open Rice. But I try myself. So we look at many thousand funds. Then I tell you why I think this fund is good. Not reading from the slides like here. So, oh, this fund does 65% loan to value. That fund is 50%. So what? But if I tell you that if everybody does 65% loan to value, I can find you a opportunistic real estate fund, return everything is about the same, but they don't borrow 65%, they borrow 30%. I would buy that all day long, because in anything you borrow less money, achieve the same return, figure out why they do that. So, but the essence of that is you point out 65 doesn't mean anything as a number, but compare relative to something, it matters.
So last question. What do you think are some good source of information you recommend? Because I think that is a very key.
Good point. The one drawdown for private or alternative investment is it's very difficult to find information on it. Why? Because it's purely because a lot of these managers, they do things, they make money, they find very cool deals privately, and they don't want other people to know. Why? Because if they publicly talk about it, or they make that I'll give you an example. The story I gave you about the China McDonald, I doubt it will make it into a Harvard business case, study case. Why? They don't want you to know. Until it's all said and done, now that it's been sold, they may make it a Harvard Business School case so that you can study about it. But the unfortunate thing is private investments is not very easy to pick up things. One of the probably better ways is, one is you can put some keyword searches in Google, or if you do subscribe to Bloomberg, you can put either the individual names of these firms that like the founders, or some of them do like to go on to Bloomberg and joining some of the conferences. But that is actually one of the I would say challenges for us or for some of our clients to get comfortable and put money and invest in private equity or real estate because I don't know, you're believing in me telling you all these things about Starwood. You go to the Starwood website, you don't see much information. But that's sort of the unfortunate thing about the alternative investments. Either you work at Starwood or you work at a bank who invests with Starwood. Not a lot of information about the firm. I don't have a good recommendation for you. I always say if you look hard enough, or you, it's like all of these managers. I would say it's not like you find someone who has an IQ of 200 and they see things that other people don't see. No. They usually have like Elon Musk. They have a crazy vision. They want to do something. They're stubborn. But usually all of the managers that we like, they're super hardworking. I would say like I raise my hand, I do a lot of technology investment. I have no social media, no IG, no Facebook, no Xiaohongshu, no nothing. WeChat, I don't use any of those. Then you ask me like, but I bet you, I can find information probably not too, maybe a little slower than you do. But I can probably, I just tell you, I won't name names. This morning, me and a couple of my colleagues, they're talking about a wife of our colleague who is a pretty famous, well, not famous, who is an artist. And this artist is what, I guess some of you might have seen or know, the Art Basel was happening in Hong Kong, it's one of the events there over the weekend. If you walk through the MTR and the bus stops, there are advertisements. The whole Art Basel picked 3 art pieces as advertisement on these places. One of the art piece apparently was painted by the wife of one of our colleagues. And then this morning we were like, oh, cool. So what's the name of it? And then they said, well, yeah, we don't know the wife's name, and we don't know which art gallery, the name of it, I couldn't find it. I was like, okay, there's like, yeah, I'll search Facebook and, all my colleagues. I don't know, I just did, my best friend all these years is Wikipedia and Google. I don't have other better ways, but I managed to find an art gallery. This woman painter was born in Guangzhou in 1984, where they went to school, what degree, all free. So Google.
How much?
It's the right question you ask. It's like ChatGPT. So I'm trying to say is hardworking and sort of like you know where to look, or you know who might know the information. It's more important than like you need to know everything.
How much do you think from the help of being in a circle, or
Yeah,
like?
no. It's very important that you actually, if you're interested in alternative investments, it's not like one industry you can join, but you can say join some of these firms up there, but you should become a specialist in one area because they usually do a few things good. Second, you can join a bank. Third, there are a few public websites because the last few years there are some private equity investment solutions that are more open for public. So you can go take a look. One of them in real estate is called BREIT.com. It's run by Blackstone. They talk about U.S. Real estate investment for income purpose, a very stable asset. So they post market studies and things like that. Other than that, unfortunately, there's other things like hland.com or bcred.com for private lending. But these are investment solutions they run. Other than that, unfortunately, talk to your friends who graduated from your school and they're working at different banks. Other than that, it is literally because there are quite a bit of I don't know what to call it, non-public information in this industry that makes some managers do their job well. Because when they do well, they're not like the mutual funds or other things. They want everybody else to know it well. They only want everybody else to know it well is by the time they're selling it. But if they know where to look for good deals, buildings, they will never let want other people to know. If they do that every year, they will just keep quietly doing that. It's our job to make sure that they're not crooks, they're not frauds. Because by not telling people, that means you can do things, you know, illegally, right? So it's our job to make sure. It's not like the police, but to make sure that these things are real.
I like to ask for the annual report of the private equity managers because they disclose a lot of the portfolio managers, their progress in the sector, and then you really learn a lot of the business practices in the sector.
It's actually it's like it's not like these people don't tell anyone about anything. It's because a lot of people either don't ask or they don't read those reports. Like all of these private equity funds, they publish like Starwood, 75-page detailed building by building quarterly reports. What's going on with the building? Doing well, not doing well. What are they doing with the building? And which sector? And then they usually have a market, outlook session in the beginning, like how are we thinking about the U.S. data center market and things like that. But to the point is like either you work at a bank or you work for some of these firms, so that you get access. Otherwise, I would just say there's no harm of the worst case is the answer is no. Like do a Google search. I always say like you never know, somebody just out of nowhere like decide to post a PDF file online. I find so many supposedly private materials online if you just want to do a search. So hard working actually works. You just do a search. I'm sure you have more ways of getting media than myself. I don't do social media, but yeah. Cool. Thank you.
So we take a 10 minutes break and we come back for the second round.
Thank you.
their stage of growth, they may not just issue common shares because of different share structure. They may issue something like a convertible preferred share, so that it has a more protection on the investor. So what does it mean? So say for example, if this is a convertible preferred share, that means originally the capital will be raised as a loan, and then the investor lend the money to the bank, so to the company, and then the company usually they have the term of the loan will have a term that the lender or the creditor can convert into the common share of the company. That's why we call it convertible preferred stocks. In case the investor doesn't want to convert, or in case the company doesn't work out, he can put back or get back the money from the investor. So that's why these terms are in the less advantage of the company, but in a better advantage for the investor. And then usually these private equity will have a very long investment horizon. So usually the structuring, for example, is around they have a called the investment period, holding period, and exit period. So usually altogether maybe about 10 years, 8 to 10 years, or even some longer. So 10 to 12 years. They have very long investment horizon. They have no liquidity or limited liquidity. That means once you invest, you are not able to get money out unless the company got exit, or the company the funds sold the company and then distribute the capital back to you. So which is very passive, and then you have no control on the liquidity. And there's a 4 major categories, including the venture capital, I mentioned about, which is all about very early stage company, leverage buyout, which is Albert mentioned, is mainly you buy the controlling stake of the company, and growth capital. You invest in something that in the middle of the stage of the company which have a fast growth period. And also distressed investing. Distressed investing is not always be available. Usually distressed investing happens when there's a financial crisis, or when there's a shock, financial market shock. That's why you will see some distress. For example, right now, there's a lot of distressed real estate companies in China. Most of them are in deep distress. So whether you can find opportunity to invest, if you can turn it around, and then you can make a good profit. So for mostly of the structure is that we have the general partner and the limited partner. What does it mean by general partner and limited partner? Usually they will form a partnership. And the partnership, the manager is the general partner. So as I mentioned before, the general partner can be also the limited partner in case they invest their own money. So general partner is essentially is the manager. The limited partner is the economic owner of the structure. For example, if the general partner raised $100 million, and then the general partner put 10 million into it, so he become a 10% limited partner as well. And the other 90% limited partner may be of another investors. Altogether come up with 100%. So usually the fee structure of the private equity is that they will have a management fee plus a performance fee, and usually the performance, we call it the carry interest, and with most of the case they will have a preferred return to the LP. That means for the most early stage or early part of the return, they will give to the LP first before they charge carry interest. And sometimes they will set 6%, sometimes they will set 8%. Roughly, this is the 6 to 8 is the preferred return. That means for the LP, in case they put in money into the private equity fund, they will get at least an IRR of that return before the fund manager will get the carry. So I will demonstrate with an example to you later. So this is a very good illustration of a private equity. So how does private equity funds work? So private equity funds generally they have a called the fundraising period, and then they have the initial closing and the final closing, and then when they in fundraising to a certain period of time, they will start to investing the money. So they will not wait until the final closing, because say for example like you mentioned like KKR, which is a very large private equity firm, they usually takes around 18 months for the whole require usually a long period of fundraising period, and the last when they have the usually the fundraising have a definite final closing. Say for example, the final closing is end of March. That means by the end of the March 2024, they cannot accept any investor. So all will be done disregarded they have raised to the limit or not. So usually for a fund they will have a hard core limit or soft core limit, and then when the hard core limit reach, everything will stop the fundraising. Or up to the final closing, if they still cannot reach the hard limit, they still have to close, because otherwise it will be unfair to the existing or invested committed LPs. So last investor commit to making the investment, and the investment may be made between initial and final closing. So during this period, they start already investing, because the team has different team. One is the fundraising team, one is the managers, investment team. So they start to commit several deals. So usually when approaching the final closing, so when the fund manager approaching you as a prospective investor, you know that they may have invested some deals. So you know that what they're doing already. So that's why the transparency will be a lot better. If you have an initial closing, so probably you may not know what are the deals they are working on. So that's why transparency will be a little less. However, for the very famous fund managers like KKR, like CDMR, or DFJ, all these good managers, when they said that I will raise another fund, usually they because they have very good track record, their previous LP usually like to reinvest. So that's why in most of the case, they may probably quite full during the initial closing stage. For example, I knew a venture capital in Hong Kong, who is very famous including biotech related industries. And I know that one of the GP, the partners, and I asked her, can I invest in their fund? Even I know it for a long time, she said cannot. The reason why, because whenever they have a new fund, they will give the priority to the existing LPs. When the existing LP already take up all of the quotas, that's why they will never open to the new investor. So this is some of the good fund managers case. That's why for these good managers, they will never be afraid of no investors, because the track record is so good. So this is something of the I would say the landscape of the private equity. So usually they have the fundraising stage, the managing and existing management, and then during this period, they will invest and exit of the deals, depending on the timing. And then finally, when they are approaching the end of the life of the fund, because all the documents will have a definite end of the fund, term of the fund, they will start to dissolution or liquidation some of the not very good deals, so that they can give back money to the investors, so that they can start a new fund again. Because otherwise it will drag on, it takes a long time. So usually it will take 3 to 5 years as the investment period, and another 3 to 5 years with the holding period, and then we call it harvesting. And then manager will seek to exit, either they through the IPO, selling to the public, or strategic sale. For example, like the McDonald case, which is a strategic sale. They sell back to McDonald, and then sell to another private company. So, and then usually the investor will generally get a preferred return 6 to 8 years, and calculate the IRR before they will get the carry. So this is the chronological chart. The other one is a very better illustration of cash flow. So we always call the J-curve effect of private equity deal. So think about that. This is the year one when you committed the capital. So they start to capital cost. The dark blue one, that means the negative cash flow for investor. When they call capital, say you pay. So this is the first 5-year period. That's the investment period. That means the private equity firm can call you to pay them capital. So, okay, maybe I illustrate a bit of it. So for private equity, there's several terms. One is called the committed capital. then there will be an exit or return. So what does it mean is that, for example, if the fund manager raised 1 billion, and then I commit 100 million, so that means during the investment period, I will be obliged to put in capital if the manager call me to pay up to 100 million. So if I commit 100 million, I will pay up to 100 million. If I commit 1 million, that means I will have to pay. So say for example, if my committed capital is 100 million, that means all these add together will be 100 million. If my committed capital is 1 million, I will add that will be $1 million. So we are according to the ratios. So what does it mean by reinvest and exit? So look at the light blue color. So light blue color is the distribution. The distribution means that when you put in the money here, next year they will start to pay you back a bit of money, depends whether they can sell the deal or sell the investment. Say, that's why you see that, say for example, if in the first 3 years you put in this deal, and then you will start getting harvest when they exit some money. So that's why you get cash flow. Usually, this is the accumulated cash flow chart. So usually you will see a J curve, that means when you have a increasing in negative cash flow, and then gradually you have positive cash flow towards the end of the fund. So in the end of the day, your total return will be the positive cash flow minus the negative cash flow. That's what the total return. Say for example, if all this I was called is 1 million, and then all these smaller light blue color add up is 2 million. That means my total return will be 2 minus 1. I make $1 million on this deal. So how to calculate the IRR based on the, everybody knows how to calculate IRR is that you tabulate all the cash flow number and then work with the computer, then you know the IRR number on that. So that's how you derive nature of the private equity deal. And then these are the illustration of the private equity. So that's why sometimes when it is in deal, say for example, when it is still within the investment period, if the return capital is very fast, the GP or the general partner can have the right to call some of the distribution to reinvest because they're still within the investment period. So in this case, that means your investment capital will be more than your committed capital. But however, this is a redistribution. That means in the total end of the day, you still do not need to pay up new capital. Say for example, in this area. So it seems that they call 20-something%, but actually around 10% is from distribution. That's why you net you just pay him out of maybe 15% or 10%, something like that. So this is we call the reinvest. So and then this is the exit and the return. So this is a very typical case of private equity structure. So that's why usually think about that. If my commitment is $1 million, and all this dark blue add up $1 million, but actually I'm not taking out actually $1 million because in year 3 and 4 I start receiving some distribution. So actually my net or actual cash outflow will be less than $1 million. So usually that's why when we plan a private equity deal, so usually we will calculate around 60 to 70% is for actual net cash flow for each deal. But of course, dependent on the timing, market timing. Right now, because of the economic situation in China, over to China, private equity will take a long time before capital will be repaid. So next, this is similar chart from Albert. Is that so? Albert, that's his fund manager selection. That's why it's very important in private equity area. So as I mentioned, it's very difficult to get the 21.2% manager. But if you can get something here, around here, or around here, you already outperform the market. So that's why we try to, by using the private equity, we try to find a good manager that gives steady return, predictable return, rather than unexpected return. So you find that venture capital in this, from 1986 to 2018, actually venture capital give a lower return than private equity. Despite that, venture capital, the expectation is a high return, high multiple. But I think during the economic downturn or some kind of event, so make the venture capital even less promising. So that's why I can say that in my planning for my client, actually I seldom invest in venture capital. I'd rather choose the good buyout fund or good growth fund. So in order to get a better predictability. So maybe I spend a bit of time give a brief this thing. Differentiation between venture capital, PE, growth, and buyout. So give you more color. So startup. Okay, apart from buyout is very straightforward because for buyout you are buying a company's control. That's why disregard whatever it can happen in this stage. But for stages of PE, these are the main stages. So startup, what startup is that? Say for example, like after your graduation, some of your students comes together. You want to start your own business. Like I would like to invent a product. I would like to sell to whatever. So you come up, you write up with a business proposal, and then ask some people to support you. So this is, we call it startup. So basically you have nothing, you just have a plan. And then you write a plan, and some people believe in you and then give you money for the plan. And then they exchange for some shareholder. Angel investment is that it is a big stage later than startup. And then you have some kind of results, the product results like prototype. Say if you develop a product, say I invented a new phone which is better than the current phone system. So you have some prototype and send this prototype to some more angel investors. Some investment managers are good in putting in this angel investment. So and you raise some money. Usually this is a very small amount of money, and you give them another shares to the angel to the company. So why we won't do these two in private equity? Because this is an extremely high risk. I would say the success ratio is less than 1% for these things. That's why you have a good expertise that people have been viewing so many people proposal and then terms, etc., so that they will put in these deals. So for some of my clients, we did some angel investment before, but so far the success ratio is still very, very low, lower than 1%. Okay, so basically, a lot of this is true. And then when this comes to venture capital, usually you have some business plan already. So you have some product or stages of business. So usually VC has already you have the prototype. For example, if you develop a drug for biotech drug, usually you have that prototype and then results, and then you will at this stage you want to raise some fund for the clinical trial. So that's why you have already achieving certain stage like products or service. So that's why for VCs you have already some kind of business proposal here. For example, if for EV, usually when you raise the EBC stage, then you have that prototype of the car can run on the street, not on the street, at least on the lab already. So on growth stage, you have that business operating, and then may have P&L, but at least cash flow is generating. It's a more steady stage, but you need additional capital to help them to grow the business. For example, like I open a one restaurant, coffee shop, for example, and then the business is very good, but I want to open 10 at the same time. So that's why I need to raise capital so that I can replicate a lot of these growth stage. Or if you're on a drug business, you have already bypassed the clinical trial, but I need to do marketing and etc. to promote my drug and etc. This will be the growth stage. Pre-IPO is that, or semi-mature business, or late stage. This about time to exit. So about time exit means, say for example, you have already, the product has been sold on the market. Like for example, in McDonald's case, is that the growth has been quite good, and then now have a good story to tell. Either I would do I would raise another round of capital for marketing, or do a marketing, or try to raise the profile so that I can do the IPO. So why? Because why usually in this stage the company doesn't need money anymore. So late stage and semi-mature. Okay, they doesn't need money anymore, but they want to raise money because they, for example, like a company, they want to raise their profile before IPO. They may invite an institutional investor, or invite an institutional investor, or invite a prominent PE firm to invest, so that everybody knows that this guy invests, or strategic investor invests, so it will be a good company. So that with the IPO, they can sell it higher. So usually, for this investor, they may looking for 1.2 or 1.5 times or 2 times at most return, not very much, or even less than, I think 1.2 to 1.5 pre-IPO. But for growth stage, we're looking at 2 times at least. That means for the period of time. And then for VC, anything above 3, 4, or 10 times, depends on companies. I'm looking for very high return. Angel investment is looking for maybe 50 times, something like that, return. So that's why these are the stages of the investment. So that's why you see that for venture capital, because the risk is higher, you look for high return. But for the private equity, the return expectation is less. So that's why during different stages, you will have different investors and different needs for investment. So somebody would like to invest in VC in small size so that they can have a bigger return. But some funds like the growth fund, they will raise big size, but invest in bigger company, the return will be lower but more steady. Because think about that, it is already a proven business model. They start making money, they just need to expand. So these are the different stages of the investment for PE. So how do we do due diligence for PE? So as Alvin mentioned, all these are very private, and then they will not have public information. So how do we do due diligence? So basically, for the fundamental approach to due diligence, we have four P's framework. We call it people, philosophy, process, and performance. So what are the people? So understand the background, the experience, and the quality and integrity of the key individuals through calls with peers, and then or if you know the company or the portfolio companies and LPs. So the team is very important because the team is the critical part of the success of the business. Not only the managers or the bosses, but also the analysts or the operation team. So that's why we need to have a strong team. So for example, like the buyout fund. So usually like the buyout fund, apart from the investment manager, they have an operation team. So like for example like KKR, Carlyle, Blackstone, and they usually have an operation team. When they do the operating team, people including engineers, accountants, investment bankers, or what else? All are the very experienced expertise from different industries. When they acquire McDonald's, they send a whole team of operating people there, and then try to figure out what's the bugs in the company, and then what's the good thing, what's the bad thing. They change a lot of things. They means they need some time to convert the whole thing. That's why the operation team is the one that the key of the success of the buyout firm. And then what are the philosophy? What is the investment approach? And then what are the lessons learned and what's the competitive edge? This is the way that we want to know through their success story, through their history, to know what kinds of deal they will be better. Say for example, they're very good in investing in biotech because they have a very good connection with the biotech engineers and etc. Or they're very good in financial industry. For example, some PE firm is very good in financial companies. So that's why you have to know the philosophy of the company. Why do they do that, and then when are they going to exit process? So how do they evaluate the idea of the sourcing, the underwriting, the self-discipline, and portfolio construction? So how many companies they will invest? What the size of the company they invest? Say for example, the company raising say like $500 million, they said that they will invest 10 companies. That means each will be around $50 million. Because the more the company invests, the less time they will focus on each company. And the thing about that, for these companies you invest in, it's not one time buy. But after you buy the company, invest in the company, you spend a lot of time to work with the portfolio company's management to change that, to help them to grow. That's why if you don't have enough people, how do they do that? So that's why the idea, the sourcing, and the writing, how do they get, how do they decide when to invest and when to exit? And then performance. So the performance, the final one or the last one you look at, the performance gives you the history of the managers and what did they do good, what did they do bad, and also the most important thing that we would like to learn from their failed deals. Because for every private equity firm, they will, for every annual report, they will list out the companies they have invested, how many, when they invest, when did they exit, what's the amount they exit. That's why they have nothing to hide, because in the annual report, you will know what are the failed deals. Say for example, you invest in 1 million, 10 million in this company, they exit only 400,000, so no failure. Then you want to know what happened to this company, what went wrong, did they learn from mistakes, and then how do they prevent the same thing to happen again, which is more important than the deal they have been successful. That's why when we evaluating the private equity managers, we always focus on the failed deals. And then because sometimes the failed deal is because their own structure or own investment, or sometimes the failed deal because of market macro environment. Say for example, we invest in a Southeast Asian company, which is I think in 2000, which is, I forgot which era. It's during the period that when the oil price drops to almost $30 per barrel, and then they invest in the Indonesian company, oil company, which is a very prominent company. They have a good management. However, because the oil price drops to that low level, that they are forced to bankrupt because of the oil price. So this is mainly driven by the macro, but not the management of the company. So that's why we want to know, and then we would want to ask if the same things happen again, or if the same situation happen again, how do they prevent total loss or etc. So which is also help us to evaluate the future success of the company. When we look beyond the 4 Ps to further our understanding of the driver and sustainability of the returns, so we also look at the competitive advantage as they compare with other fund managers, and then how do they structure the deals, and then what are the culture, and then one important thing that we want to know, how do they reward their people? Because think about that, a lot of people want to join the private equity firms. If, say for example, if I'm a very smart structurer, I'm a smart analyst, I'm a smart lawyer, whatever, I join the private equity firm. But after I join the private equity firm, the economic downturn. So which is none of my fault, none of the company's fault. So during the economic downturn, the deal cannot exit because the market is bad, I cannot sell the deals. So these are the things that you have to think about that, because if during the economic downturn and the people and the operating team cannot sit tight, work together, the deal will become a total failure. But if the deal can work together and ride over to the and then hopefully the market will return back. Because it happened that during the 2008 and 9, we invested in a fund called KKR Europe. So you know what happened? KKR is the European bio fund. So it was a very successful fund in the first 2-3 years because the market is booming. But we have the financial crisis. Everybody knows what happened in 2008. So all the stock market crashed, 30-40%. So basically there's no exit. The capital is there. So, but the KKR company, they know that they have to ride through it. That's why they cut costs. They help the operating company to cut costs, make sure the cash flow is positive. Because all these companies are good companies, just timing is bad. So that's why they make sure the company can ride over the economic downturn. And then after 2-3 years time, they start to re-IPO the deal. We have to sell the deal again. Although in lower multiple than their expectation, but still making return instead of losses. So that's why the firm's capability to the culture of the capability that is very important. So that's why when we look at these things, we all think about that. Private equity, as I mentioned before, when you enter into private equity, you cannot exit. So that's why it's a very important when bad times come, what to do with that. So as an investor, you have no choice. But as the people inside the firm, they have choice. They can quit. So if I'm a very good analyst, okay, the private equity, I know that my portfolio company will not go IPO in the next 3 years, but I will have no bonus for the next 3 years. I'll rather jump ship to another firm and do equity trading or whatever, it will be better. However, if the firm can build a culture, they have a cushion. When they have hard time, probably the bigger bosses or bigger partners will keep the staff there to make them have good living or substantial living to have a good culture. It's very important. That's why some of the firms, they may not pay out all the bonuses for the success to the people. They have a reserve in case bad time comes, so they can reward the people. So these are the culture, the structuring, and the operation are very important in these private equity deals. Because private equity is I would say it's the most complex investment in the whole financial universe. The complex is that they're not that rocket science. It's easy to understand, but however, there's too many uncontrollable. That's why we have to build in a lot of cushion, margin of safety for this kind of product. So next I'll talk about private credit. So as mentioned, private credit has similar structure of the private equity, basically just focusing on investment in a specific sector of the credit-related products. So this is lending money to a company along the capital structure of the underlying company. So namely the mezzanine debt, real estate debt, LBO deal, special purpose debt. So all these debt are just have a special purpose. Why do I want to lend that? Because like mezzanine debt is one level below the shareholder equity, and then they will have usually the debt will be incorporated with we call it a warrant. That means that they will have an upside and can participate upside. Real estate debt, straightforward, linked to real estate related, and then usually they have the collateral and the real estate collateral or the underlying real estate as a collateral. Leverage buyout debt. Interesting. This leverage buyout debt is just work together with the leverage buyout deal. So remember, if we talk about the leverage buyout, let's say for example, like KKR want to buy into a 50% of the company. So they will not put it. Say for example, if it costs say like McDonald's deal, it costs 2 billion. They will not put in 2 billion, but they will put in, say for example, maybe 1 billion and borrow 1 billion from another firm to this is the LBO debt. So some firms that they will lend money to the LBO due to do acquisition. That's why they call it LBO debt. And then some special purpose debt, say debt for a specific purpose like distress or whatever. So these are the private credit, and then usually these will not be making profit because, and then usually the tenor will be a lot shorter than normal private equity deal. But sometimes right now because of for marketing purpose or for ease of attracting retail or individual investors, they will make it as a sandwich. They will allow you to have a quarterly redemption. But the redemption they have some certain restrictions. One of the characteristics, usually these they have a periodic income distribution, not like private equity. They do not have income, but for these they usually have a quarterly income because they are lending as a debt. So that's why they pay coupon. So they will have a periodic income distribution. Same, no limited liquidity, but also they may have a quarterly liquidity, and usually they will incorporate leverage on that. So that's why sometimes the bank will lend them money for this leverage, and shorter tenor than private equity and lower management and incentive fee because it's a bit more simple structure. Once you do it, you have less boring work. Not like a private equity, you still have a team to go into the company to sit in the board meeting, to have a meeting with the operation team, etc. So this is another area of the private equity, private credit deal. So the other area is real estate. As I mentioned, also this different types of real estate, like commercial and retail, residential and industrial. Nowadays, a lot of these real estate we call it, instead of in general real estate, we call it special purpose real estate, like digital centers, like logistics centers. Because of the rise of the e-commerce and COVID, the demand for digital data center and logistics center have been rising substantially. Like if you go all the way from Kowloon all the way to the airport, you see a lot of big logistics centers. Because of e-commerce, they need a lot of logistics centers. So that's why a lot of the factories being converted into logistics centers. I have a client that have a big piece of land in Shanghai, outskirts of Shanghai. Originally they had a factory to manufacturing clothes, and then he told me that he closed down the factory because it's not profit making because of the difficulty to make profit on manufacturing clothing. They rent it out to a Japanese logistics company selling diapers in China. So, and then even they collect the rent is even a lot better because less people to manage and a very consistent cash flow. So that's why to invest in this type of deals, so a lot of the private equity firms would like to create a fund so that like you are being a small investor, you can also participate into a logistics center or participate in a data center. And afterward they will release these private equity into a REIT. They put it into a public listed real estate investment trust, like Lingris. Everybody knows about Lingris, which is listed in Hong Kong, or the Singapore government are very famous in doing this real estate investment trust in Singapore, including data center, including commercial, retail real estate. So that's why they will create a lot of real estate funds, same format like the GPLP format, and also the real estate investment trust, like this Lingris Maple Tree Logistics Trust. So this will give the retail investor to participate a piece of ownership on the real estate. So as I mentioned, all these real estate investment, they always incorporate leverage. Say like REITs, they will borrow money to invest. Like Blackstone, they will borrow money to invest in real estate. Otherwise, the return will not be that good. Think about that. It looks very good, so that retail investor or individual can participate in a real big investment project. However, the fees are very high. They charge $220, or they charge another annual management fee, and then for managing the logistic trust and etc. That's why in order to jack up the return, they usually incorporate certain leverage. And then by kind of finance, for example, like link risk, they borrow money to invest in the shopping center, and then refurnish it, and then rebuild it, and then sell it. So which is, I think everybody knows the link risk listed in Hong Kong, and used to create a lot of noise because at those days the government make a wrong decision by selling 100% of link risk to private. So that's why, but the link risk, you know that originally link risk owns all the shopping center, the housing estates, shopping malls in Hong Kong, like Stanley, basically all these shopping malls that belongs to link risk. And the government selling it out, that's why they so
Monopoly.
social responsibility converted into purely commercial activities. So that's why they raise the car park rental, they raise the shop rental, but they also rent away everything to become a commercial. So good thing is that we have a better housing estate shopping center, but bad thing is that for the people living there, they have to pay a higher fee for everything. So these are the example of link risk. I'm not saying it's good or bad, but for investors it's good. But for the people living in that shopping center area, it's bad because you have to pay a lot of fees. So the mom and pop shop will be closing down in exchange for parking shop or a bigger restaurant chain, but no more local restaurant there. So these are the good thing and bad thing. And nowadays, link risk changed their strategy by selling the Hong Kong real estate project and then go into China. And that's it. So what are the advantage and disadvantage of alternative investment? Usually they have a lower return correlation with traditional investment over a long period, because they're nothing concerned with the fixed income or equity directly. That's why and also they can be very specific. That's why they have a lower return correlation with the traditional investment over a long period of time. So you can further diversify portfolio risk and expansion of the efficient frontier. Remember we talked about the efficient frontier, and then the possible return enhancer. So like if you invest in private credit, you get a higher dividend yield for your portfolio because you don't need liquidity. That's why you can earn a high liquidity, earn a high yield because of give up the liquidity payment. So remember that we talk about in order for the investment to be liquid, the yield will be lower. The lowest yield is cash deposit because it's a higher liquid. But if your money do not need liquidity, you do not need to take money out to use any time, why not just lock up something longer term and get a higher return? So in order to get a possible return enhancer. So that's why we're focusing on absolute return most of the private equity deals and less market volatility. So because they have a lower reporting volatility, because usually these private equity deals, they will mark market only on a quarterly basis at most. They will not mark market on a daily basis or monthly basis, usually on a quarterly basis or even half yearly basis. That's why you see the statement valuation is less volatile. So I'm not saying that whether it's true or not. Say for example, just like when you buy an apartment, there's no point for you to market every day, right? Because you don't need to sell it, and then you just create unnecessary worry for you. If you see read the newspaper today, the price of the property dropped by 10% year today, and then you see want to know what's the valuation of the property, and then you start getting worried because it seems that your wealth deteriorates. But however, it doesn't really matter because you're not going to sell. That's why liquidity or the volatility will affect your return. You keep it low volatility, and then high liquidity premium, but while you don't need it, this is a waste of your ability, your resources. So alternative investment drawbacks. So you have the limited risk and return data on alternative investment, as I mentioned before. It's very less transparent or no transparency, and then the traditional risk measure may not be able to capture the risk characteristics. You cannot use the traditional way to evaluate the investment. It requires a high level of investment knowledge and expertise to understand the alternative investment extensive effort on product and manager due diligence. You have to spend more time on due diligence and in the product due diligence. You have to read through, if you want to go into detail, read through the very thick pages of offering memorandum. Fees are higher, and also you have to pay the profit sharing fees and a limited access to manager with good performance history, as I mentioned before. So most of these managers are close to new money. That's why you have no way for you to you're not able to invest in this good performing manager. For example, like some of the hedge funds, they're close to new money, and then we always get connected to this hedge fund manager to try to understand when will they reopen to new investors, and usually they have a limited liquidity and restricted to redemption window. So this is after knowing all that, what does it mean for our portfolio management? So these are the historical correlation of the different asset class and different type of strategies. So that's why, for example, like if you look at real estate asset, global infrastructure fund, transfer timber fund, you see there's a pretty low correlation to these traditional asset class because of the nature. And then some of the strategies may have higher correlation. For example, like hedge funds, equity long short, they may have higher global equity correlation. Or private equity, they will have higher correlation to global equity. Because in a matter of fact, despite their liquidity, despite their being a private fund, they still invest in companies. So say for example, if I invest in McDonald's, say for example, the private equity fund, and then operating business in McDonald's. But if the Hong Kong, China market economic downturn, and then people like COVID, if this is compared with the sales of Cafe de Coral or Kentucky Fried Chicken, if the business is bad and then share price goes down, I think the valuation of McDonald's will also mark down in the next quarter, something like that. Because in the end of the day, private equity return still tied into the operation efficiency or the performance of the underlying company. So this is underlying business. So that's why when you chip into different kinds of asset classes, you want to have the lower correlated assets to achieve a high return. So that's why we want to, this is the next page, that is the ultimate objective of the portfolio management. We want to move the pie chart from southeast to northwest. That means from a bit higher volatility, but also high return, and higher return but lower volatility area. Say for example, if you can move the pie chart from with a 13% volatility with a 9% return to a similar volatility, similar to it but a lot lower volatility. That means longer term, this portfolio is a better portfolio. Your capability of getting a consistent return will be higher. So this is something that, like for example, like some statistic data, like 60% equity, 40 equity, 60 bond will have this annualized return. But if you have a 50% equity, 20% bond, 30% off, probably you have a high volatility but also high return. So if you want to maintain the low volatility, probably 30% equity, 40% bond, 30% off to get the best outcome. You have a high return but low volatility. This is something that we would like to achieve. So theoretically, it can be done, but actually you need a lot of effort and try and error. The reason why, because for alternative investment, as I mentioned before, the dispersion of return is so high. That's why you continuously try to fine-tune or optimize the portfolio. So this is another illustration of different asset class. So like correlation and yield, for example, like direct lending, the correlation, and also the transport infrastructure correlation. So probably you see that the correlation of transport infrastructure will have a higher yield but lower correlation to the traditional traditional asset class. These are the sizing and bar chart of the compared to different asset class and on real estate. And this is another illustration of the alternative and manager selection. So for the primary secondary market, so the deviation is not that much, but for the alternative manager, so the deviation is very important. So you can see that like the global private equity, the dispersion can be from 3.8% to 24%, and then from venture capital, if your investment skill is bad, you will lose because the deal of losing money is pretty high on venture capital. While for the hedge funds, the dispersion is a bit less, but still there's big dispersion. Did I cover all? Last week we talked about the hedge funds, right? Last week we talked about the hedge funds, and then like some rational hedge funds and etc. And if we have time in the future lectures, I try to bring some examples to you. Although it may not cover in the exam, but then for you to know more. So is there any course called alternate investment? Who had it? Pen? How is it? Good. Is it cover similar thing?
Yeah.
But do they have a lot of theories and
So actually they divide each asset class as one topics for like one lecture.
one lecture? So okay, this is when did you study it?
Class next year.
Does it recall anything from that?
Yeah,
Because I don't know the recall. Maybe you share me what did you teach? No, just the course outline. I want to know what they cover and how cover. Because sometimes because